Perfect. Hi, folks. My name is Lukman Otunuga, Senior Research Analyst at FXTM, and today I'm joined with Han Tan, Market Analyst based in Malaysia. I want to welcome all of you to our Market Outlook number 6. Just wow, look how time flies. Before we proceed, though, I just want to confirm if everybody can hear me and Han clearly, and you can also see our screens. I'd like to see a show of electronic hands if everybody can hear and see us clearly.
Yep, so this is Han Tan coming to you live from Kuala Lumpur, Malaysia. Certainly appreciate those of you who have taken the time out to be a part of this webinar. So we're going to try and make it as interactive as possible. But first things first, like Lukman said, just doing some housekeeping, making sure you can hear myself and Lukman all right, and you can see our screen. You will find the button for the raising of hands on the, I believe should be the right side of your screens. And then you can just do a hand raise there. And that will give us the cue to go ahead and get this started. Thank you, Christian, for that hand. That's only one. Maybe the other two are still trying to figure things out. Or you can just post it in the questions box, which Lukman will explain to us in just a bit, but you can just let us know that you can hear us loud and clear in that questions box as well. Okay, might as well get familiarized with it, yeah, because we hope that you'll use the questions box during this webinar as well, right, Lukman?
Yeah. I mean, this is going to be a really interactive session. We have a lot to talk about. I mean, as I said, this is Outlook number 6. We've been doing this for the past 6 months, and all I can say it's been nothing short but phenomenal. You know, there's been a lot of action across equity, currency, and commodity markets thanks to the growing list of themes that is just influencing market sentiment. We have a lot to discuss, people, from the Fed's inflation shift to the dollar's outlook to gold prices. But I think the key theme in today's webinar is the fact that the Fed has relaxed its hold on inflation. So meaning that the Fed has now said that they're going to let the US economy run hotter. Now, this is very interesting given how for an extended period of time, the central bank has had that golden 2% target. Now they've relaxed this target. We're going to discuss what this means for financial markets, currencies, commodities, and what setups can come in play in September because of this. But before we get to the fun stuff, let's quickly talk about the disclaimer. So I just want you all to know that the content presented comprises of personal opinions and should not be construed as trading or investment advice. This is from me and Han. Trading forex and leveraged financial instruments involve significant risks and can result in a loss of your invested capital. You should not invest more than you can afford to lose and should ensure that you fully understand the risks involved. Trading is risky at all times. Now, let's get to the fun stuff. I'll hand it over to Han, which will start with the dollar. Who will start with the dollar? To you, Han.
All right. Thanks for that, Lukman. So again, just want to confirm that all of you can hear myself and Lukman just fine, and you can see our screen. And if you can do that, please feel free to raise your digital hands. You can find that option on the right-hand side of your screens, because we know that more than half of you had just joined us over the last 30 seconds or so. So we are still seeing some people come in. Thanks for your hand, Edward. Okay, so I think that's my green light. I should go ahead and get started. All right, let's look at the dollar index DXY here. Look, so here's what the Fed's new approach to US inflation could mean for the dollar. The short and oversimplified answer is we expect the dollar to weaken. Okay, now here's how currencies and inflation work. So with the Fed allowing US inflation to run above 2%. Okay, so they're saying, look, over the coming years, if it goes to 2.5, 3%, they are okay with that. In the past, they would try to intervene with interest rates, move those interest rates before, right, the inflation actually gets beyond 2%. So if they start seeing some heating up in prices in the US, they would move. Now they're saying, you know what? go ahead, inflation, do your thing, go above 2%, we'll just sit back. Okay, that's the relaxed approach. So what that means for the US dollar is that the purchasing power of the dollar weakens. In simpler terms, that US dollar can buy less stuff. Okay, because if the Federal Reserve, allows the prices of goods and services to run higher, then the dollar can buy less stuff, right? So that's the idea. So long story short, we expect this bias for weakness for the US dollar over the coming years, and we expect that to perhaps get started. Well, it's to be honest, it's kind of started since March. That's due to different reasons, but because of the Fed's new approach to U.S. inflation, we expect that trend to continue. Okay, so first, a potential headwind. Headwind means that it's going to push back against the dollar index that's trying to gain. So that's because of the Fed's new approach to inflation. The other one is what's happening in the U.S. Treasuries market. So I'm going to give you some live data right now. So if you look at a 10-year US Treasury yields is about 0.7%. So the idea that is if you're going to buy a 10-year US Treasury bond, right, the note from the US government, you're only getting about 0.7% in yields, okay, between now and whenever that note matures. Now, in real terms, real means that we strip out inflation. Okay, so you take that 0.7% and then you remove what markets are expecting inflation or where it would go. Then you're actually down into the negative. So you're at negative, some live data right now, negative 0.99%. Okay, so in other words, you're kind of losing money, right? So whatever you gain in yields from US Treasuries, it's not gonna be able to help you store your wealth and climb above inflation, or at least keep up with inflation. So that's the idea, okay? So that's going to dampen the appeal of the US dollar, okay? Now, on the other side of the coin, we have potential tailwinds. Tailwinds being, these could help push up the US dollar. So one of them being the short positions look overstretched. That means that, markets or investors who have thought that the dollar would weaken some more, it looks to be running too high. In fact, just to give you some timeline here, we prepared this presentation on Thursday, right, Lukman? Thursday. And we do this webinar on Monday. One of the big reasons is because on Friday, the CFTC, I won't get into the full details, the CFTC releases all these data about how leveraged funds and asset managers are going to position themselves over the coming week. Okay, and sure enough, even though I prepared this presentation on Thursday, on Friday it was announced that, look, investors are saying, maybe the dollar may not see as much weakness, at least for this week, and they are actually less bullish on the euro as well. And we'll get into the relationship between the euro and dollar in just a bit. Okay, but the idea is that, look, those who expected the dollar to weaken a lot more, that looks to be, just a bit overdone. Okay, but net, I still expect a bias for weakness. Something else to look out for this week, of course, the US Senate, they reconvene starting tomorrow. And of course, the big thing, if you've been following the news flow, is the US is set to announce another round of fiscal measures to support the US economy. In other words, the government wants to spend, right? Maybe about 1 trillion, maybe less. We don't know what the actual size of that package will be. So the size of that package, as well as the timing of when that stimulus package will be rolled out, I think that can have an influence on the US dollar. Okay, so we're looking at the dollar index here. So with that said, here are some support levels and resistance levels that I'm looking at. Obviously, given the bias or weakness, I think the support levels will come into play more so than the resistance level. But if you look at this chart, there is that very steep red line that started from that peak in March all the way to where we are right now. And you are seeing this pretty stubborn dollar is trying to punch up above that red line. We'll see if it actually can do that. Now, that's on the dollar index. Now, another currency or a currency that will have a major say on the dollar index is the euro. Now, for those of you who are not familiar, the euro accounts for more than half of the dollar index. Okay, I don't have the exact figures in front of me now. In fact, let me just pull up those exact figures. It's 57.6%. Okay, of the dollar index. Okay, so where the euro goes, it's often reflected in the dollar index, as you can see on this chart right here. That blue line is the dollar index, and the white line is euro dollar. Okay, so weaker US dollar, so like I mentioned earlier, that should boost the euro. And then of course we have seen a lot of support measures being rolled out into the EU economy already, right? Now some potential headwinds would be ECB, that's the European Central Bank. They could intervene in the euro, because over the last couple of weeks you have heard euro officials and economists already say, look, this euro strength has gone on for a bit too much. They are starting to watch this very closely. Here's why, just to give you some economics 101. If you want your economy to recover, especially if you are an economy that's reliant on exports, like Germany is, and Germany is the largest economy in Europe, then you want your currency to be weaker. The idea is that when your currency weakens, your exports then become more competitive. It is easier to sell it in the global markets. All right, so that's the idea. So when you have a currency that's too strong, it doesn't really help your exports, doesn't really help your economy. Okay. Another potential headwind will be the resurgence in COVID-19 cases. We just saw some news flow coming in just a couple of hours ago, how some hotspots in Europe are rising. Once again, as they try and ease up their respective lockdowns. So if that becomes a huge flare-up, then we could see some weakness in the euro. But having said that, I think it will have a limited impact, because we have already heard from the leaders of France and Spain saying that, look, we have done a national lockdown already. It came at a big cost. We're not going to do that anymore. That's what they say. I'm sure the virus could have different say on what they actually do. All right. So with that said, let's look at the chart here for euro dollar. So so given, I think the bigger threat would be what the ECB, the European Central Bank, might do to try and limit the strength of the euro. So I think it could struggle to stay above 120 against the dollar. A stronger resistance at 121, like we saw back in 2017. Support, you can draw that around the 117 region, which is the lower range or the lower bound of the range that we saw in the end of July. And then if you do break below that, then we can see that peak around March of this year at 115 hopefully play its role as a support measure. Okay, real quick, I just wanted to I missed this one fun little factoid. Just go back to that dollar slide here. So if you look at this table here, some of you may have heard this out there in the markets when you read news stories or come across some reports. There tends to be a seasonal bias for strength in the US dollar in the lead up to US elections, all right? And we're about 60 days away from the US elections. When I took a deeper dive into it, I mean, not too deep a dive, I just looked at the performance for the month of September before US elections. That trend may have been stronger, in the 90s and 80s and going further back. But if you look over the last 20 years, and we've had 5 US elections since, you don't really see a clear trend, right? In fact, over the last couple of elections in the month of September, before the November elections, the dollar index has actually weakened. So I have my doubts over whether that seasonality effect, whether that age-old saying that they have in the markets that the US dollar will strengthen in the lead up to the elections. I'm not so sure about that. So that's just something to keep in mind and color the markets as we move along. Speaking about moving along, I'll throw it back to Lukman, who's going to talk to us about the S&P 500. Plenty of movements in the US stocks now, Lukman?
Thank you for that. And yeah, Dan, I share the same thoughts with you with the dollar and especially the euro. The euro has been one of the dark horses in 2020, but that upside seems to be could be limited, especially when we understand the relationship. How a strong euro may impact the European economy. So yeah, back to the S&P 500. People, I mean, who would have thought that over 6 months after the coronavirus menace basically paralyzed the global economy and battered financial markets, the S&P S&P 500 would not only erase its 2020 losses, but jump to record highs on repeated occasions. As I said earlier, Han, it's just amazing. I think 2020 will be forever remembered as the year where we had the shortest bear run ever. It's just great stuff. So the S&P 500 year to date is actually of like roughly 6 to 7%, since the start of 2020, despite those steep losses we saw back in February, March. And there's a couple of key drivers that's really, driving the S&P 500 and, NASDAQ and stock markets higher in general. The first one is the fact that we've seen the Fed go unlimited QE back in March, resulting in trillions of dollars in monetary stimulus in the markets. Of course, the US government has also done its job by, approving that handsome fiscal package, earlier this year as well. There's rising hopes of a coronavirus vaccine, breakthrough. This is supporting this sentiment, and it's essentially driving investors towards riskier assets. This is another key thing that seems to be supporting the S&P 500 and the stock markets in general. And believe it or not, the pockets of positive economic data we're seeing here and there is renewing a sense of confidence over the global economy actually recovering quicker than expected. This is quite interesting. Let's see how this plays out. So I've got a colorful chart of the S&P 500 and inflation. The theme of this month's webinar is, the Fed relaxing its inflation. And we could actually see, just looking at things, over the past 20 years with US inflation, the S&P 500, there seems to be some sort of correlation, especially back from 2001 to 2006 and 2013 moving forward to 2020. So I've actually said that inflation could be a double-edged sword. So Hans already covered this, but let me just recap. The first thing that came to my mind when the Fed relaxed its stance on inflation, allowing the US economy to run hot, is the fact that we're not going to see a hike in interest rates anytime soon, meaning that if interest rates are likely to remain low for an extended period of time, businesses will essentially enjoy the ability to finance operations, at a cheaper rate. Lower interest rates stimulates business investment. This is part of the things that, drive economic growth. This is why stock markets in general were pushing higher. But then the other thing is, okay, if the Fed is going to allow the US economy to run hot, and inflation moves towards that previous 2% golden target, a moderate increase in inflation is actually good in the short term. It helps GDP, it helps boost consumer demand and consumption, especially if it allows, general prices, income to rise. But on the other hand of the equation, though, if inflation, runs rampant, we have a scenario where inflation actually spikes well beyond that 2% target, goes back to 2.5 and hits levels not seen since, if you look at the chart right here, since back in 2008. This could actually have negative consequences on the US economy and, hit S&P 500, especially if the rising cost in general eats into corporate profits. So I've got a chart, the next chart of the S&P 500, and you can see the target, the title, Fed inflation shift to keep the party going. Right now, speaking of things, purely technical, we see that S&P 500 has actually been on a tear in 2020. It's been amazing. There've been consistently higher highs and higher lows. Me talking more technicals, the simple moving averages, prices are trading above the 20 and 50 simple moving average, while on a bullish, time frame, prices are actually respecting, a bullish trend. I've got some key levels of interest: the 3,500 level, 340 and 320. A monthly close above that 3,000 technically may encourage an incline higher to fresh all-time highs. Sustained weakness below that 350 level could encourage a decline, a pullback lower. As we've been saying, everybody's been saying that, the brutal decline we saw, especially last week, the end of last week was a healthy pullback, and, sustained weakness below that 3,500 level could actually encourage a deeper pullback in the short to medium term before we see a potential move higher. But, looking more of the S&P 500, it's mostly driven by fundamentals, and as long as there's optimism of the global economy, as long as there's speculations over more stimulus measures, equity bulls are likely to remain in the game moving forward.
Yeah.
So that's the S&P 500. Oh,
May I just intervene here real quick?
absolutely.
Just a couple of notes here. So, ladies and gentlemen, just a reminder that you don't have to wait until the Q&A session that we have in just a couple of minutes from now. You can actually start sending in your questions now already, and you can find the tab on the right side or you should have like a panel right on the right side of your screen there on GoToWebinar. So feel free to find the questions tab and you can just type it in and we'll be more than glad to answer them in just a few minutes from now. Lukman has got one more section here, but also a couple of things. So just the RSI, just a quick correction on the what you see on the screen there. The RSI, while it was well into overbought territory, but then it actually just hit 70, but then obviously because of the sell-off that we saw on Thursday and Friday in the US, it is now, the RSI has fallen below 70. For those of you who are not familiar, 70 on the RSI, that's the relative strength index. That's an indicator, a technical indicator that it has reached overbought levels. And often when the RSI hits 70, you tend to see a bit of a pullback, all right? So which is, I think, what we saw over the last couple of days. US markets are closed today, so we'll see how the S&P 500 performs on Tuesday when they open. Although US futures S&P 500 right now is in the red. But yeah, enough about the S&P 500. Get your questions in. Lukman, back to you for gold, please.
Absolutely. Thank you, Han. So back to gold. I think gold has been one of the winners in 2020. If you look at the metals year-to-date gains, believe it or not, gold is actually up almost 30%. When I looked at it this morning, it was up 27%. And you know, gold has been one of those interesting assets this year that have just been able to shine through the chaos. You know, there's many key factors that are driving gold prices higher. Number one, we've got low to negative government bond yields. You know, since the Fed went on limited QE, you know, quantitative easing or buying government bonds, you know, it's actually increased the price of bonds, essentially reducing the yields. So back to Economics 101, the opportunity cost of holding gold has declined due to this, essentially boosting appetite for the precious metal. Another thing that's actually boosting appetite for gold is the fact that we've seen some rising coronavirus cases in some parts of Europe and the United States, as Han actually highlighted earlier during this webinar. This represents a major element of uncertainty, accelerating the flight to safety, essentially pushing investors towards safe haven destinations like gold. And of course, we've got the political uncertainty ahead of November's presidential elections. There's a lot of questions right here. So, you know, when we add all these themes together, you know, it actually supports appetite for gold and allows, you know, the allure for gold to continue shining. So what does the Fed policy shift mean for gold? Well, it's widely known that, you know, gold is an inflationary hedge because its price in US dollars is variable. So essentially, it actually holds its value as the dollar possibly decreases due to the impacts of rising inflation. So if the Fed, you know, is going to allow the US economy to run, hot due to, you know, in an effort to, you know, stimulate growth, this could be good news for gold. Essentially, you know, making its outlook, you know, bullish in the medium to longer term. The question is it time for gold to rebound towards 2000? I've got a colorful chart right here showing the correlation, you know, relationship between gold and inflation. And, you know, it says that, you know, there is a correlation between, you know, inflation and gold, as we can see, since especially back in 2010, 2011. So if inflation is set to rise in the United States, if the Fed is allowing inflation to rise in the United States, this could result in gold prices pushing higher. I've got a chart, gold's outlook for September, possible levels to look out for. So, apologies. So we've got support at 1910 and resistance around 1985 and 2000. You know, and for an extended period, I've been saying gold has been waiting for that fresh directional catalyst, you know, and it looks like it's still in the range right now, you know, like a ping pong ball bouncing here and there. You know, looking more at technicals, prices are trading below that 20 simple moving average. And we have you know, essentially a breakdown opportunity to look out for in September. You know, a breakdown below that 1985, you know, 1985 regions could encourage a decline, apologies, a breakdown below that 1910 support regions could encourage a decline towards 1890 and possibly lower. Alternatively, though, if we see a breakout above 1985, this could instill gold bulls with enough inspiration to retest that psychological 2000 level and possibly higher. As I said, September is going to be a very interesting month for gold, and let's see if bulls are able to test that 2000 level.
Right, great stuff. So we've only got a few more minutes for the Q&A, and we do see a couple of questions already. So thank you so much for that. So we want to be respectful of your time. We understand that, well, we've been kind of told that we certainly went over that 30-minute limit over the last couple of months, the couple of webinars that we did recently. So we're going to try and stick to that. So first question comes from N1. So I believe this is kind of directed at me. So the question he has is, well, what am I expecting in September? Is more of a bullish trend for euro to dollar and to the pound, right? So essentially weaker dollar. So the simple answer is yes. Now, to be clear, I'm trying to get more clarity this week, all right? Because this week, like I said, number one, the Senate is going to come back into session starting tomorrow, September 8th. And then we'll see where they are at on the US fiscal stimulus. And then number two, I want to see, whether Christine Lagarde, the ECB president, whether she herself would actually jump on that bandwagon of saying, look, the euro strength has just gone on too much. Because over the last couple of weeks, it was just the economists, and we did see the euro react to those comments. Now, if we do see the ECB president herself, right, talk about it, then I can see more dollar weakness. And then, like we said, because more euro weakness, because like we said, the euro accounts for more than half of the dollar index, right? But at this point in time, without those answers to those questions, my expectation is still for more dollar weakness over the coming months, really, not just September, okay? And also mainly due to the main theme of this webinar, that being the Fed is looking to allow US inflation to run hotter above 2%. Okay, we've got a few more minutes. I'll get those questions in. Otherwise, I'm going to actually ask you guys some questions, and maybe, we'll do one right now. So let's see how many of you actually share that kind of sentiment that I have. I've just launched a poll. You guys should see it on your screens right now.
Dollar week.
Right? Will you guys see this? Yeah. So yeah, well, US dollar weekend in the lead up to the November US elections. So I've stated my case. Now, again, for the record, this is not to be construed as investment advice. And also keep in mind, we are approaching things from a fundamental perspective. Lukman and I engage in fundamental analysis. So that tends to be a lot more useful on the longer time frames. Significantly less useful when it comes to 5-minute candles or 15-minute candles that some of you might be accustomed to. All right, but then looking over the next 60 days or so, how many of you think that we could see a weaker dollar? You can answer yes or no. Looks like we've got a yes pulling into the lead, but we will give it another 30 seconds or so, and then we'll see where you guys are at. Lukman, how about you tell us then? Well, you did say you agree with the weaker dollar bias, eh?
Absolutely. Like I said, I'm coming clean. I entered this year, so I'm coming clean. I entered this year thinking the dollar will remain the king of the currency markets. Nobody could dethrone the dollar, but look at now, in Q3, and the dollar's been beaten black and blue by, not only G10, but Asian and most emerging market currencies. Just looking at the fundamentals, the factors that are really weighing on the dollar's really going to struggle to snatch back its throne anytime soon. We need to see a major shift in the themes that are really influencing the markets.
All right, so we will, I think that's enough time for that poll. 63% of you said yes, that you expect the dollar to weaken as well. We will see what happens by the time you join us for our next webinar, which is on the first Monday of next month. But then going to that second question, well, before we go to that second question, I'm going to issue this other poll here. And this one is for you, Lukman, because this is about the pound. So Lukman's all the way in London, UK, And before we get his outlook on the pound, which one of you asked about, I want to pull up this poll. Yeah, so lend us your thoughts. I still follow Brexit developments closely. Now, those of you who've been following the news, if you have been following the news, the next round of Brexit negotiations will actually start this, well, today, right? So,
Yeah.
Lukman, perhaps share with us your outlook on the pound as the good folks out there give their thoughts about whether they actually follow Brexit developments. Well, do you follow Brexit developments, Lukman?
I've got no choice.
Yeah.
I mean, when we're looking at Brexit, it's starting to, sound like a broken record. Literally
Yeah.
throughout 2020, it's been back and forth, left and right, extended deadlines, and what's happening right now is because there's just so much uncertainty and so much time wasted. Probably the pound is becoming the pound, not only pound in general, markets may be becoming complacent in regards to Brexit. We've got a very, very short period of time until the ultimate deadline, and fears are rising. There's the risk that the UK may actually leave the European Union by the end of 2020 with no deal. And I think this is the last thing the UK economy needs right now, especially after experiencing its first economic recession in 11 years. So what I can say is with Brexit, this has been my motto since the start: always expect the unexpected, and naturally this will result in volatility in the British pound.
Yeah, so for the 10% of you, or well, 9% of you now who said yes, you still follow Brexit developments closely, that was Lukman's take on it. Obviously, for Lukman and myself, we have to, because it is our job. Fundamental analysis, you got to consider the Brexit threat, but about a third of you said no, you don't follow closely, and more than half of you said you don't care anymore. I mean, we understand because this has been going on since 2016, so let's wrap
Yeah.
it up, right? Speaking about wrapping up, before we wrap up, how about just one last poll? Just want to, well, we have certainly given our take on the markets. We want to see where you guys are at. Let's do one on, U.S. stocks. Why not? Because that's always popular, right? So let's do U.S. stocks. Okay, so when we say U.S. stocks, we look at the indices, S&P 500. Are you guys seeing this? Yes, S&P 500 and NASDAQ. Do you think they have already reached their record highs for 2020? So like I said, Thursday and Friday last week, huge sell-off led by tech stocks. The NASDAQ 100 even flirted with a correction. What that means is it dipped from the peak to its lowest over the last couple of days. It fell by as much as 10% before coming back a bit slightly. I'll give you some live data right now. US futures, even though the US markets are not open today, live data right now, well, Dow futures are actually in the green, S&P 500 marginally red, NASDAQ 100 still more pointing to about a 100-point loss. But again, a lot can happen between now and when US markets open on Tuesday, their time, right? So let's get your thoughts on this. We'll see where you guys are at. Wow, interesting.
Wow.
Okay, so 2/3 of you disagree. So 2/3 of you think that, look, there could be more upside here, new record highs perhaps for the S&P 500 and NASDAQ. Well, a third of you agree. Look, it's pretty much as good as it got in August, well, early September. And yeah, it's perhaps all downhill or perhaps treading water from here on out. I can understand that outlook because, like Lukman mentioned, we've got some key risks. The US elections are just less than 60 days away. But if I had to pick one side, oh, well, it's still moving. So now it's 50-50. Ah, interesting. Okay.
Whoa, yeah.
What a fickle crowd we have now. I just started talking and then to 50-50. So, Lukman, I'll get you to share. Well, you have shared your outlook on S&P 500. Because it's split right now 50-50 among you guys based on this poll. What my take is that I think that there's still some upside. Okay, so I think we could see some more record highs for US stocks before 2020 is over. So some of the reasons that Lukman gave was because, look, with interest rates so low, I think investors, and some of you are probably seeing this right now. If you stash your money in the bank, right, the interest that you get on your fixed deposits or whatever are really low. I know it's very low here in Malaysia. All right, so it could be pushing many of these retail traders like you guys out into the markets, right? So, but this is where it can get really fickle, as we saw with this poll, right? If there is this fear factor, and there aren't, like, say, fundamentals or other broader strategies or time-tested strategies to guide the market participants, especially the retail guys, yeah, then we could see this huge flocking towards the exit doors, right? But from a fundamental perspective, because of the Fed's influence, and also because of the business models that the tech sector has in this pandemic, right? I think we could see a bit more upside here for the Nasdaq, US tech stocks, and also perhaps the S&P 500. S&P 500, though, it depends on the rotation. What that means is, investors are saying, okay, look, we have had our great summer in tech stocks, just like Masayoshi Son of SoftBank has just reported over the weekend. He spent a lot of money on options, on call options, to buy some of these tech stocks. Now, if they rotate, that means they perhaps put less money in tech and go towards some of these more conventional sectors like banking, consumer-related sectors. Then we could see S&P 500, get new tailwinds, right? New reasons to push higher. Okay. So final tally on the poll is now, well, 56% of you disagree. So 56% now says that you expect more record highs, and then 44% say agree. Look, it was as good as it got last week. All right, great stuff, great insights. Lukman, back to you for some housekeeping then.
Absolutely.
Right. So, so we have this. I guess I'll do it then. So just a reminder, ladies and gentlemen, as we wrap this up, look, the content that we shared comprises personal opinions and should not be construed as trading or investment advice. Trading Forex and leverage financial instruments involves significant risk and can result in the loss of your invested capital. You should not invest more than you can afford to lose, and should ensure that you fully understand the risks involved. Trading is risky at all times. But before we go, Lukman, talk us through how these good people can reach out to us on social media.
Yeah, guys, again, thank you for attending this webinar. It's always fun. We've discussed really good stuff. If anybody still has more questions, we've only been speaking for 30 minutes. If me and Han had a chance, we'll be speaking for hours and hours and hours, but there's only so much we could cover in this short time. You can follow us on Facebook. Literally just type FXTM on Facebook. Twitter, also on Twitter. My Twitter handle is Lukman_FXTM. I think Han, yours is Han _FXTM. So follow us, reach out to us on Twitter. We're more than happy to answer any questions market related, be it currencies, commodities, or stocks. You could also follow us on LinkedIn and Instagram and YouTube as well. YouTube, I normally do my week ahead, week in 60 seconds. Tune into that. Also follow us on Telegram. Just search FXTM on Telegram. It's been an absolute pleasure, guys, and literally we'll see you guys in a month's time. There's many more things to discuss about. Who knows what we're going to speak about next month? Let's see. We're just a month away to the presidential elections. Anything could be on the cards. But yeah, thanks again, guys, and please keep safe.
Thanks so much, guys. Good to see you guys, and thanks for your participation. See ya.
Yeah.